Hey there, my name is Karen Jones, content creator for the Society of Technical Analysts. I want to revisit a view that we had recently that I thought the US dollar index was likely to be a longer term base. It seems to have actually peeled off from that key resistance and the dollar seems to be back under pressure. And when we look at the euro dollar daily chart, which is in front of us, we can see that the market seems to have stabilised well ahead of the low that we got back in July at 113.91 and is also well supported by its 200-day moving average at 114.62. We're currently in the process of eroding our 55-day moving average, which has already been given way, but where we've gone to and stopped at for the moment is the 50% retracement of the last leg down. So it does seem to me that this bullish view of the dollar has to be parked for now because euro dollar is showing some signs of residual strength. So let's have a look at big picture where this becomes important. Please note that the recent high on euro dollar was at 119.19. Now, when we look at longer term charts, we can see clearly that the market has recently topped at the top of a 3-year up channel. We expected this failure to actually head a bit lower. We expected a reaction back to the 112.75 peak that we got in 2023. We haven't got that. It seems to have stabilised ahead of that. So that is somewhat neutral for now. We've seen a reaction lower, but it hasn't gone as far as we thought. Now, when we look at the very long-term chart, we can see that, again, that 3-year channel is in evidence. But what is also in evidence, and I think a key trend denominator, is the 200-month moving average. Now, that's at 119.60. And I think this is pretty pivotal from a longer-term point of view. If you look back in history, you can see very sharp reactions from and to the 200-month moving average. We saw it in 2010, 2012, and again in 2018. So I think that will be the key level to watch. While we're capped by the 200-month moving average, I can assume that this perhaps is going to be some sort of topping pattern. However, a monthly close above the 200-month moving average at 119.60, and that will also take out the previous high at 119.19, we would have to assume that there is some longer-term upside bias for this market. So current prices, I would have to say, are pretty neutral. I can't really get heavily invested in either one. I've got a 50% retracement where we seem to be struggling on the top side. However, we seem to have eroded the 55-day moving average, and we're holding well above the 200-day moving average. And the trend is currently pretty much sideways. So I just can't get myself worked up to be married to either view. Thank you.